Australia is in the grips of a well-documented housing crisis as home prices continue to climb with demand still outstripping supply.
Western Australia's health minister is in India on a mission to recruit thousands of healthcare staff to fill shortages across the state.
In newly built apartments and townhouses. It's a $210 million investment that will provide homeowners with lower upfront costs.
Picture this. The WA government just announced another first home buyer assistance scheme. Premier Roger Cook stood at the podium, smiled, and promised it would make home ownership more accessible than ever. But here's what they're not telling you. Every single time the government introduces one of these schemes, whether it's the first homeowner grant, stamp duty concessions, or 5% deposit guarantees, property prices don't go down, and they go up fast. In October 2025, the federal government expanded the Home Guarantee Scheme, allowing virtually any first home buyer to enter the market with just a 5% deposit.
From the 1st of October, it's happening. Every Australian can buy their first home with just a 5% deposit. You won't have to pay a single dollar in mortgage insurance.
Within 2 days of the scheme launching, properties under $500,000 in Perth completely vanished from the market. First home buyer Brooke Rolfe told Yahoo Finance she used to see a few options when filtering for affordable homes. 2 days after the scheme launched, there was not one house anymore. And Perth prices? They surged 1.6% in September alone, making it the second fastest rising city in the country. Asking prices climbed even higher into October. Active listings dropped nearly 30% year on year. So what's really going on? Why do government schemes designed to help first home buyers keep making housing less affordable, not more? In this video, I'm exposing the uncomfortable economic truth that politicians won't tell you.
This will make it easier for Australians to get a foot onto the property ladder. This is actually going to do the opposite.
These policies aren't designed to help you buy a home. They're designed to keep the housing bubble inflated, protect existing property owners, and ensure banks keep lending at record levels. And according to some of the world's leading economists, this exact pattern has created housing bubbles across the entire planet. And Perth is heading for the same crash that destroyed markets in the US, UK, and Ireland in 2008. Let's get into it. Right, let's start with the schemes the WA and federal governments are currently spruiking to first home buyers, because understanding how they work is critical to understanding why they're a con job. The Federal Home Guarantee Scheme.
All first home buyers will only need a 5% deposit to climb onto the property ladder under an expanded federal government scheme.
From October 1st, 2025, virtually all first home buyers can now purchase with just a 5% deposit. The government guarantees up to 15% of the loan, which means lenders don't charge, which are lenders' mortgage insurance, LMI. For a $700,000 home in Perth, you'd only need $35,000 up front instead of $140,000, saving around $28,000 in LMI. The scheme is now uncapped. No participant limits, no income caps, no race to secure limited places. The property price cap in Perth was lifted to $850,000, up from $600,000. The WA First Home Owner Grant, a one-off $10,000 payment for eligible buyers purchasing or building a new home valued under $750,000 in Metro Perth, or $1 million in regional WA no-income test. Stamp duty concessions. Since March 2025, first home buyers pay zero stamp duty on properties under $500,000, with concessional rates up to $700,000 in Perth. That's a potential saving of up to $18,000. Now, on the surface, all of this sounds bloody fantastic. Lower deposits, no LMI, government grants, stamp duty savings. What's not to love? Here's the problem.
This is a con job. The impact of these policies over time has been to do the exact opposite of what the policies claim to do.
These schemes don't increase housing supply. They only increase demand. And when you pump more buyers with more borrowing power into a market with limited supply, basic economics tells you what happens. Prices go up fast. Professor Hal Pawson, Director of Housing Research and Policy at UNSW, put it bluntly. The first home owner grant is one of the least recommended ways that you can assist first home buyers. Researchers from UNSW Sydney, RMIT University and University of Sydney found the scheme added to demand and pushed up property prices despite more than $20 billion of public funds being spent on it between 2010 to 2020. And it's not just Australia. This exact pattern has played out across the entire developed world. Here's what most people don't understand. Perth's housing boom isn't unique. It's part of a coordinated global phenomenon where governments treated housing as an asset class to be inflated rather than as shelter for people to live in. According to the Bank of International Settlements, which maintains a database on house prices across 14 countries going back to the early 1970s, houses are far more expensive in real terms in all but 3 of them, and the increases are staggering. The UK saw house prices rise 5 to 6 times in real terms, meaning prices adjusted for inflation. Your wages haven't risen by a factor of 5 or 6, but the price of the houses you're trying to buy have risen that much. Even though we all focused on America because of its subprime bubble and the global financial crisis, the US is only in the middle of the pack. Number 8 of 14 countries in terms of price increases relative to the 1970s. So what's driving this global housing bubble? According to economists who predicted the 2008 crash, including Professor Steve Keen, one of the dozen economists who actually warned of the global financial crisis 18 months before it happened, the mechanism is simple but devastating. Rising house prices are caused by rising levels of mortgage debt. Let me explain this properly, because it's the key to understanding why Perth's boom will end in a crash. Mainstream economists think in equilibrium terms. They ignore the banking sector. They imagine banks are just intermediaries who transfer spending power from one person to another, and therefore the change in debt should have no significant macroeconomic impact. But in the real world, banks create money when they lend. That money is used to buy goods, services, and assets. Rising levels of household debt drive up the level of house prices and share prices. When you look at the relationship between house prices and mortgage debt statistically, you get a reasonable correlation when comparing the change in house prices versus the change in mortgage debt. But the main causal relationship comes when you look at the change in house prices and the change in mortgage debt, what economists call the acceleration of credit. The correlation coefficient is crazy high, according to Professor Keen. And this holds true not just for America, but for Australia, the UK, and every other country that's experienced a housing bubble. In plain English, when banks lend more money faster, house prices explode. When they lend less money or slow down lending, house prices crash. And here's the Perth-specific data that should terrify you. Australia has the second highest level of household debt to GDP in the world. Behind only Switzerland, Australian households took on mortgage debt equivalent to over 100% of GDP, far exceeding the levels that triggered the US crash in 2008. According to data from 2025, Australian household debt sits at over 200% of average incomes, making Australian households, and that includes Perth, some of the most indebted in the world. And what do governments do whenever there's a danger of falling house prices? They pump it up again with schemes exactly like the ones we've just discussed. Let me take you back to 2008 because Perth has been through this exact cycle before and the outcome wasn't pretty. The early 2000s saw Perth's property boom fueled by a flourishing resources sector and booming economy. Prices surged as the mining boom brought interstate and overseas workers flooding into WA properties were selling fast. Rents were climbing and everyone thought the good times would last forever. Sound familiar? Then came 2008. The global financial crisis hit. Mining sector demand dropped and Perth's property market corrected during the crash. But here's the critical part. Perth's boom lasted longer than it should have because the Australian government intervened with massive stimulus. In October 2008, Economist Professor Steve Keen appeared on the ABC's 7:30 report warning that Australia faced its own savage correction, including an inevitable housing slump.
I took one look at the ratio, its rate of growth, and I thought, holy hell, it's growing exponentially. There has to be a breakdown coming at some point. Someone has to raise the alarm, and at least in Australia, I'm probably that somebody.
He'd been warning about the dangers of rising house prices and mortgage debt for 18 months before the crisis hit, and he was one of the few economists who actually predicted the global financial crisis. 6 days after that interview, the Rudd government doubled and trebled the first homeowner grant. The federal government gave up to $21,000 to first home buyers purchasing existing homes or new homes. The Victorian state government added another $14,000 on top, encouraging people to buy new houses on the periphery of Melbourne. And it worked, temporarily. People went back into buying housing. That stimulated credit-based demand, and credit in Australia never went below zero. Whereas in America, it went from plus 15% of GDP to minus 5%, a 20% swing. Australia avoided recession during the global financial crisis. But the price that Australians paid, and this is the price paid by young Australians rather than rich old Australians, was higher house prices, making it even harder for them to get into the housing market. The impact of these policies over time has been to do the exact opposite of what the policies claim to do. Back in 1988, almost 44% of Australians owned their own home outright, and less than 30% had a mortgage. Fast forward to 2018, and the number of Australians who own their homes outright had fallen from 43% to 31%. Those with a mortgage went from under 30% to about 38%. Renters went from about 17% to 27%. These policies have reduced home ownership, increased the number of people with mortgages, and increased the percentage renting, exactly the opposite of what politicians claim they're trying to achieve. And Perth? After the government stimulus wore off and mining investment declined in the 2000s, Perth experienced a brutal market correction. Prices dropped significantly, and it took until 2020 for the market to stabilise and begin recovering. Now we're in another boom. The same conditions, the same government interventions, the same rising mortgage debt.
So this is something which benefits the landlords while you pretend to help out the tenants convert from being tenants to house owners. It is an insane policy, but it's indicative of what's been done worldwide.
And economists are warning when this boom ends, the crash will be worse. So where is Perth's market right now? And what are the warning signs that this boom is about to end? Price growth slowing. REIWA forecasts Perth house prices will grow 5 to 10% in 2025, down from 24.2% in 2024. Unit prices are expected to slow from 21.4% to similar single-digit growth. Westpac experts forecast annual price growth will ease to 4% in 2025, compared to the recorded 10% for 2023. KPMG projects Perth house price change will reach 10.2% by December 2024, but decrease to 5.2% by December 2025. Days on market increasing. Properties that were selling in 8 days at the peak of the boom are now taking longer. This is a key leading indicator that demand is weakening. InvestorKit identified 4 key indicators that historically signal the end of property booms: rising days on market, DOM, climbing vacancy rates, increasing vendor discounts, widening gap between sales volumes and for sale listings. In Perth's last boom that ended in 2014, these exact patterns emerged before the 5-year downturn. In Sydney's 2016 boom, DOM started rising and vacancy rates climbed before prices declined in 2017. Hobart mirrored this cycle, with early indicators flashing red before prices declined in 2023. Affordability constraints hitting hard. Perth's price-to-income ratio has gone from 5.8 times in 2023 to 6.4 times in 2025. The median home now costs more than 6 times the median household income. A 2025 CoreLogic survey found 24% of new Perth borrowers were already spending more than 35% of income on repayments, the threshold for mortgage stress. Experts' warning of unsustainability. Strategic Property Group Managing Director Trent Fleskens warned, "Given there has been no change in our immigration numbers and no ability to build houses any faster or cheaper, there's no reason to suggest 2025 will be anything other than another strong year of property growth. But prices can only go up until we suddenly double our construction or halve our immigration." The question isn't if Perth's boom will end. The question is when and how bad the crash will be. So what actually happens when Perth's housing bubble bursts? Let's look at what the data and history tell us. Price corrections of 15 to 30%. Based on Perth's 2014 to 2020 downturn and international crash data, a correction of 15 to 30% from peak prices is realistic. For a home bought at $800,000 at the peak, that means a drop to $560,000 to $680,000. Negative equity. Anyone who bought with a 5% deposit at the peak will be in negative equity immediately. You'll owe more on your mortgage than your home is worth. You can't sell without bringing cash to settlement, and you can't refinance. You're trapped. Forced sales and foreclosures. When people lose jobs during the mining downturn, they can't make mortgage payments. Forced sales increase. As more properties hit the market, prices drop further. It's a vicious cycle. Rental market collapse. As seen in Perth's last downturn, rental drops of 30% are common. Investors who bought for cash flow suddenly have negative gearing properties with falling values. Many sell, flooding the market with even more supply. Economic contagion. Construction slows. Real estate agents lose jobs. Mortgage brokers struggle. Retail spending drops because people are in mortgage stress. The entire WA economy contracts. First home buyers get destroyed. The people these government schemes claim to help, first home buyers, get hit hardest. They bought at the peak with minimal deposits. They have no equity buffer, and they're most likely to face job losses in a downturn. According to the Bankwest Curtin Economics Centre, 210,000 Western Australian households already view their housing as unaffordable, up from 110,000 just 2 years ago in 2022. When the crash comes, many of these households will face financial ruin. And here's the kicker. The government schemes that encourage people to buy with 2% and 5% deposits will be directly responsible for creating a generation of young Australians trapped in negative equity and financial stress. So if these policies make housing less affordable for first home buyers, who actually benefits? Existing property owners. Every time the government introduces a new scheme that inflates prices, existing homeowners see their property values increase. Roger Cook, the WA Premier pushing these schemes, he's a property owner.
Young people to borrow more money than they'd otherwise do, to hand it over to the vendor, and that helps drive up the house prices, and that benefits the wealth levels of older Australians, like Albanese himself, who are landlords.
Politicians benefit personally from policies that inflate the housing bubble. Banks. When first home buyers take out larger mortgages with 5% deposits, banks lend more money and earn more interest. Rising property prices mean more lending, more debt, more profits. The construction industry, builders and developers love inflated prices because they can charge more. Government grants that only apply to new builds directly subsidise the construction industry. The financial sector, mortgage brokers, real estate agents, conveyancers, valuers, everyone in the property transaction ecosystem profits from higher prices and more transactions. Who loses? First home buyers, renters, young Australians, key workers, the future of the country. This is a policy designed to inflate asset prices to the benefit of old people at the expense of young people, and it gives an illusion of economic progress when it's actually locking the country into a form of penury. Perth's housing crash isn't a question of if, it's a question of when. The government schemes being marketed as help for first home buyers are actually making the bubble bigger, pushing more young Australians into dangerous levels of debt and setting up the conditions for a catastrophic crash. We've seen this pattern in America, in the UK, in Ireland, in Spain, in Australia in 2008, and Perth specifically in 2014. The warning signs are already appearing: slowing price growth, rising days on market, affordability constraints hitting record levels, and price-to-income ratios that are unsustainable.
While
The
it's
ugly
illegal
truth
for
is that
property
these
managers
schemes
to
aren't
disclose the
designed to
amount
help
they've been
first
offered,
home buyers.
it's become more
They're designed to protect existing property owners, keep banks profitable, and maintain the illusion of economic growth while younger Australians are locked out of home ownership and buried in debt. If you're a first home buyer considering using these government schemes to buy in Perth right now, understand what you're walking into. You're buying at the peak of a boom with minimal equity as a buffer, in a market showing clear warning signs of an impending crash. You're not being helped. You're being used to prop up the bubble for a little bit longer. I'll be covering Perth's property market every week, breaking down the data, exposing government policy failures, and tracking the warning signs of the coming crash. Subscribe to Aussie Explained Housing, so you don't miss the next video where I'll be diving into exactly which Perth suburbs are most at risk when the crash comes, and which areas might actually hold value. The government is lying to you about these schemes. Economists are warning you about the risks. History is screaming at you about what happens next. The question is, are you listening? Thanks for watching. See you in the next one.